We continue to get more numbers that indicate that U.S. economic activity is really starting to slow down. According to Challenger Gray and Christmas, the number of layoffs in the United States was 38% higher in August than it was in July. A 38% increase in 1 month is more than just a little bit startling. And many believe that if this momentum continues, we could soon be facing an avalanche of job losses similar to what we witnessed in 2008. And without a doubt, all of the other economic numbers that have been rolling in lately also confirm that the U.S. economy is heading into harder times. But is our country ready to handle another major economic downturn? Even though there have been moments of difficulty over the past decade, we truly haven't seen anything like this since the last financial crisis. In fact, the latest job cut numbers that we just got from Challenger Gray and Christmas are the highest that we have seen during any August since 2009. Job cuts rose 38% over July, with 53,480 positions to be slashed from employer payrolls, led by workforce reductions in healthcare, which had been a mainstay of recent job creation, the tech sector, and manufacturing. So why is this happening? Well, certainly there are many factors at play, but Andrew Challenger has singled out the trade war as one of the biggest reasons. Employers are beginning to feel the effects of the trade war and imposed tariffs by the U.S.
The strike against General Motors is already taking a toll on the country's largest automaker. GM stock slid more than 4% yesterday as more than 48,000 workers walked off the job. Some estimates suggest GM is losing as much as $50 million a day. Dean Reynolds is at a GM assembly plant in Detroit. Dean, is any progress being made?
Good morning. Well, a source told us that yesterday's meeting was very tense, so if there is any progress, it's happening very slowly. And the workers here told us that they will choose the picket line over the assembly line for as long as it takes. So far, workers here see little reason for optimism as the strike enters its second day.
The corporation is making a lot of money right now, and we just asking for our, fair share.
General Motors made $8.1 billion in profit last year. Patricia Brown has worked at GM for 34 years.
You don't want to do all the work. What do you think about that, huh? They just sit back behind that desk.
Union auto workers like her are looking at only $250 a week in strike pay, about $6.25 an hour. GM has proposed over $7 billion in investments, more than 5,400 new jobs, and wage increases, but union leadership told us only 2% of workers' demands have been resolved since negotiations began in July. A major point of contention is health coverage. According to an automotive news report, union auto workers pay just 3 to 4% of their medical costs, and GM's opening proposal called on them to increase that to 15%.
Automakers see rising costs, and they want some more contribution from workers.
Cox Automotive executive analyst Michelle Krebs says the divide between GM and the union comes as the industry faces major changes.
How many jobs will exist because of electric vehicles, autonomous vehicles, automation? Those are issues of real concern.
تأتي هذه العملية في إطار حقنا المشروع والطبيعي في الرد على جرائم العدوان وحصاره المستمر على بلدنا منذ 5 سنوات. نعد النظام السعودي أن عملياتنا القادمة ستتوسع أكثر فأكثر وستكون أشد إلى
And joining us now to discuss interest rates, metals, and all your favorite topics is Peter Schiff of Euro Pacific Capital. Peter, welcome back. And there's so much to get to since we last spoke, but including oil. But I want to start by getting your take on the latest Federal Reserve news breaking Tuesday afternoon. An interest rate cut is, of course, expected at this week's open market committee. Seems like a fait accompli. But in the meantime, the Wall Street Journal says the Fed reportedly had to take action to keep the federal funds rate in their target range with $53 billion in repurchase agreements. Fox Business and other outlets say it was closer to a $75 billion intervention. Diagram the mechanism of this intervention for us, and what are the implications of this Fed action moving forward?
Well, first of all, I think the financial media and Wall Street is being much too complacent about what's happening, and their instinct is to sweep it under the rug as no big deal. But I think it really is the harbinger of what's to come, because, you know, the Federal Reserve has been artificially suppressing interest rates, particularly since the 2008 financial crisis. And by keeping interest rates artificially low, they have created a bubble that's much bigger than the one that popped in 2008. And what happened this morning is that you could see the air coming out of that bubble, because the market is trying to bring interest rates higher, because we have no real savings in this country. We have enormous debt. Everybody is levered up to the max, government, the private sector, business, consumers, because rates have been so low, we've borrowed so much money. The market wants interest rates to be higher, but the Fed doesn't want to allow that to happen, because the road back to normal interest rates is a very bumpy one, because it's going to take us right through another financial crisis. So the Fed is trying to keep interest rates artificially low, and they almost lost control of it this morning. Now, they created, what, $50–70 billion out of thin air to supply the credit that the market needed. But what happens next time? What happens if we need $100 billion? What happens if we need $1 trillion? Because eventually we will. Eventually the Fed has to choose between destroying the dollar and allowing the market to bring interest rates to a level that makes sense for an economy with this much debt, and then all hell breaks loose because we have a much worse financial crisis than the one we had in 2008.